back to the Robert Review, ladies and gentlemen. I'm Robert Morris, your friend in success. I'm happy to be back doing a new show for you for the first time in quite a while. And I know that this sabbatical really, to me, was going to be permanent. I didn't know if I was going to do the show anymore, but I kept it on the logs, and I kept airing interviews from people that I thought you could really get something out of. Not just to re-air old shows. I never re-aired something I didn't think that was so beneficial that you could watch it a few more times. But now I realize, through some recent things, that this show's at least not done with me. There's still some things that people need to know. Because recent activity has shown me that the education has just not penetrated widely enough. Okay? Let's talk about the current decline in the stock market that everybody thinks is happening because of events across the world that are tragic, but are not causing the stock market to do new things. See, that's the difference between all of us out there and the insiders in Wall Street. There is a perpetuating idea that news affects the daily workings of massive money managers, and therefore the little people too, like you and me. Now, we are not little people because we are the people that give the masses of money that allow these money managers to have something to manage, true. But also, where do we get that from? I think we get it from the financial news media, from movies, from TV. And it's perpetuated because the media needs us to watch in order to have a business. But their business is not doing us any good. See, the market just doesn't do new things. Find people that really make a massive, successful living in the stock market, and they will show you that charting patterns, techniques, taking the emotions out, have everything to do with how the stock market operates, how the big money flows. And the big money doesn't flow just because things happen in the world differently. The Middle East has been at war for years. This decline has been happening since before anything happened in Israel. July was the start of an S&P INDU, a market-wide decline that people are talking like it is a catastrophic event. And to many people, they've lost a lot in their portfolios, and that is real, that is personal, that is true. But why is that? It's because we all need to stop buying into this idea that buy and hold is a strategy that works, okay? And I know a lot of people are going to be pissed that I just said that. I'm not saying that I don't own companies that I may not ever sell. But I am saying that I own companies that I constantly look at and evaluate whether to keep. And when declines are going to happen in the market, I don't know, but I can kind of sort of see when they're going to predict probability happen. When their probabilistic decline, when their probabilistic starts are going to happen. And I can offset my declines to the downside with puts, and then take that money and buy back into the stock, or just put aside. And if there's really going to be a large decline, like IRA-wise, 401k-wise, if I had one, I just put my money in cash. You don't have to always have your money working for you. And that's what we need to talk about today, is that if you just step outside of yourself for a second and say, why do I believe that holding forever is a good idea? Is it because my money manager says so? Is it because some magazine told me so? Is it because Jim Cramer told me so? What do all those things have in common? They benefit from you being in the market. Now, granted, I do too. I don't want everybody to pull their money out of the market, because at some point, the baby boomers that leave this earth, their money being pulled out of the market is going to cause a vacuum that's going to cause a decline that You can throw money at it and it won't stop. And those kinds of things you have to be prepared for by knowing how to see them so that you can profit from the downside. Otherwise, you're just profiting from the upside of the market, and the market only goes up maybe 2/3 of the time. And those 2/3 take longer to happen than the 1/3 decline. See, things take longer to go up than they do to go down, right? So the down is strategically placed to cause you to lose a lot of your profits if you don't place yourself in a mindset of trying to figure out a way to know or to be ready when it does happen. You don't have to predict the start. You just need to see that, okay, it's been going down for a couple of weeks. It's going to be going down for a couple more months. Let's pull my money out. Because, okay, the last big decline we had was in 2022, right? Let's look at the charts. Looking at the S&P 500, you can see that the decline that we had in 2022, okay, started around the same time as we expected, or at least I expected the market to decline, because the year 2 is usually a year of a massive bear market. And pretty much the whole year it declined. And if we're just using the S&P as a benchmark, the rise that has happened since the end of 2022 and to the beginning of the decline in 2023 was not enough to offset the loss if you had just held through the decline back in 22. So you're still down in your account going into the July 23rd decline that happened. And then if you watch the chart here, look at it, man. Just on the monthly, we're set up to have another month of red. Probably. But October, a lot of declines, crashes, major crashes have happened in October historically. So it wouldn't be a surprise. That July to September is usually a time of low volatility. There's a lot of profit taking that happens in the summertime. So is it really a surprise? It doesn't have to be. And that's what I'm saying. Are you wrong for having lost money? No. But I'm trying to help you see a light that I am so thankful that I have seen. Because I believe that everyone out there, if you subscribe to the notion that I need to take a little bit of time to learn how to read some charts, not as a professional, but just for my own benefit, that you can probably have yourself a better return over time. There's 3 things that I think you could do differently to benefit from these declines. Okay, and that's what the rest of this show is going to be focused on. Because you can see clearly that sometimes the ups don't last long enough to counteract the losses from the declines. So what do? When you really think about it that way, how do you win? I believe you win by strategically buying and selling rather than holding for long periods. If you're going to hold for long periods, then number 2, you have to position yourself to have money set aside to buy puts to offset the losses in your stock. So if I own a company like Pepsi or Costco or Cat Tractor or Boeing, if the stock moves a lot, I'm going to have to do it more than less. If the stock like Pepsi doesn't move a lot, then I can probably get away with a little less money set aside to buy puts. And I probably won't have to do it very often. But when I do, I can be prepared. So you either want to do one of 2 things, in my opinion. There's a way to own stocks where you don't necessarily own them all the time. There's not a way to not lose money in the stock market, but there is a way to offset the losses towards the gains. Throw the scale in your favor more. Let's say, for instance, with Pepsi. Maybe instead of just buying, throwing a dart on the wall and seeing what sticks and buying just because you know it's the fundamentally great company, Maybe you take the ideas of what makes a great company to you. You have a list of companies that you want to buy, but you only buy the ones that set up after a decline, ready to go up for a time, and you only hold them while they're in a rise. Now, you're not going to be able to predict the perfect up, the perfect bottom, and the perfect top, but you can easily be able to see with some chart reading work that, okay, historically the charts have shown that after these declines here, I can buy. When it has begun to turn up, I'm not going to hit the up at the beginning, but I can get it closer to when it's already established, get the chunk in the middle, and then as the up begins to top, whether or not it is the top, I don't know if it's the top or not. So I'm going to judge it as the top, and I'm going to sell, take my profit, set aside, wait for Pepsi to decline again, and buy again. That is one way to do it. The number 2 way to do it is the buying and holding with the offsetting. That's why hedge funds are so profitable, guys. It's not the best strategy when it comes to having all your money working for you, but it's the only way. Say you had 70% of your money in the stock and then 30% set aside for when the stock gets in a declining place where you know it's going to decline for like months or 4 to 5 weeks at least. You're going to take that 30%, buy those puts, let it drop. Most of the time, you're going to offset that decline with the profit from those puts. Number 3 way, or number 3 thing in this scenario, is don't buy index funds. Now, I'm not a registered financial advisor, still don't know that I'm ever going to be. But in my opinion, if you really want to put yourself in a place to do better than the masses, you got to do what the masses don't do. The masses of people own mutual funds and index funds. Masses of people, I would say a good amount of people, probably close to 70% of the population, will always die broke. So don't do what they do. Do the opposite. Find the stocks that perform the best in that index fund and do the strategies we talked about earlier with those stocks. I mean, that's what I do. I don't even really subscribe to the idea that right now is the best time to buy and hold any company. But my money can work for me during times of the year when the market's going up by buying a company that's also doing well and profiting. And there's other things that we can talk about that will allow you to benefit. But that is a big mindset shift. My target strategy for every account I have is 20% a month. And I regularly hit that. So if you're willing to then come to the table and say, okay, look, I want to start to change the way that I look at investing. But you keep talking about the charts. I don't know how to read charts. What do? This is what I would do. First and foremost, you got to figure out a strategy for yourself. See, my charts don't look like other people's charts because I have certain indicators that I pay attention to, and those certain indicators are set to a particular formula, right? So there's, you could have a directional movement line that doesn't look like mine. You could have a MACD line that doesn't look like mine. That's, I don't even know I think it's moving averages convergence, divergence. I don't know what it. You could have a Bollinger Band that doesn't look like mine, but for the most part, you need to get a charting software, do some research, and find indicators that you feel like you can rely on, and study the heck out of those things. And then the universal piece of this is the candlesticks, guys. Candlesticks are the best way to chart because you could draw it yourself. You don't need a computer to track it for you. The candlesticks alone, with Bollinger Bands added in, can teach you a lot. And then you add in the moving averages, 21 day, 55 day, or 55 day period, 233 period, maybe a 337, maybe a 987, which is a really long, doesn't move a lot. See, the moving averages can be like support and resistance lines for your candlesticks. And of course, the 21 is going to move faster than the 987. But you can see where the pressure of the market is moving. It's like a roller coaster ride. When you're going up and you see those candlesticks being pushed by the pressure of the moving averages, and you see the Bollinger Band being pushed by the candlesticks, and then all of a sudden it hits the top of the hill of the roller coaster. It can't push up anymore. It has no more fuel. The pressure's not there. And the indicators that you have chosen, they've run out of push too. They've run out of fuel. They're at the top of their scales. That's a major, major red flag. The decline can happen. But then a decline can't just start. A roller coaster can stay at the top of that hill forever without a push, right? Or without a pull down. So you need a catalyst. What are the major catalysts in the market? Well, there's really only a few, and you can pay attention to those, use those to your advantage. Earnings, stock splits. News is a catalyst during certain times of the year. And the major, what I call market movement zones, which you're going to have to do your own research to figure out. But I can tell you that the pockets of which, all right, January, February earnings season, one of the best of the year, okay? Mid-February, early February to mid-February, usually a time for a decline. Mid-March can have a small pop. April can be a time of wishy-washiness until late April. Tax time can pull the market down. May, June, okay, you got April, May earnings. Then June, warning season. May can be a 50-50 month. June, upside potential. July, warning season. Then you got August. All right. I'm sorry, June, warning season. July and August earnings. They are one of the less catalytic earnings times, but they still have good movements. One of the best declines, puts of this year happened at the very beginning of August, and it was super profitable if you saw it. You can look and go back on your charts from about August the 2nd on any stock. Boeing, John Deere, Cat Tractor, CMI. You can just look at the NASDAQ and the triple Qs, which I trade a lot, which is an index, and I tell you not to buy indexes, right? But I trade the heck out of them. I don't own them. I trade them. All right? All of those declined massively starting in August. There was that July decline from the market, a bump up, and then the August shoot down. Whether or not you know it, the market flows in a pattern historically year in and year out. Back to the pattern. August earnings ends, September, usually a lull. usually follows what August does with a decline after the 10th of the month. And then you got the November earnings season, which November can be a huge upside if the October decline doesn't happen. And the October decline happens based upon mutual funds selling off their losses, and whether or not they're skilled at doing that is a deciding factor in whether or not the market is going to have a massive sell-off. I just think that in the long run, if you're going to own index funds, you're kind of boxing yourself into having to do some chart reading, to having to put it into the fundamental calendar that I just talked about, to having to not just buy and hold, but buy and sell strategically during the year. And I think that's perfectly okay. But to really put it on steroids, if you set the indexes aside, or if you don't buy the index funds and you buy the indexes, like the SPX, the Russell, the NDX, or the OEX, or individual stocks using the earnings catalysts, buying and selling every 90 days based upon what they do historically, chart-wise, going into and out of earnings. I think you will benefit yourself over the long haul massively. And that's just the best way for me to jump back into this, is to talk about the difference in mindset. And that's the tip of the iceberg. But it really does take the blinders off when you start to think that way, and you start to see how massively different life can be when you're not pigeonholed into investing like we've all been taught to invest from just looking from the outside in, when really the way to do it in a more stress-free manner, I would say, with emotions removed, is just totally different. And it comes from a fundamental difference in how we look at investing. And we can get into more of that. Maybe I'll continue down this road a little bit in the next show.